everyone wants a 1031 exchange.
Yep.
They want their cake and they want to eat it too, right?
Yeah, that's right.
They're great because they defer taxes. They kick the can down the road. The problem is that 1031 exchanges right now, going from an active deal to another active deal for someone like me as a self-managing landlord, the deals don't make a lot of sense.
Yep.
The number's hard to pencil out.
Yep. That's
Hey,
correct.
I save taxes,
Right.
but I'm kind of making a lateral move in a deal making, which great. Not a whole great reason to do it. Hey, good afternoon, everyone. Chris Lopez here, and welcome to our show called The Deal Room, where we underwrite and look at live deals in the marketplace. So this is our second in the series. We kicked off in 2025. And what we are going to be underwriting today is a 183 unit Class A mixed use development in downtown Colorado Springs. Now on the screen there, this is a conceptual rendering of the 8-story building. But again, this is a real deal we'll be talking about. So we're actually tackling two parts of it here. One is the underwriting, because underwriting, in almost a 200 unit ground up development is just fascinating. And those spreadsheets are a lot more robust than the typical ones that I use when I started out as a self-managing landlord. Now, the second area we'll be talking about on here is this happens to fall in a qualified opportunity zone, which has some amazing tax benefits. Has a lot of similarities to a 1031 exchange. So we'll be talking about what those tax benefits are like, because if you hold it for 10 years, you can walk away with paying zero capital gains on the appreciated asset and without the hassles of a 1031 exchange. But I am joined by the managing principal and also the developer on this project, Adam Fenton with Narrate Holdings. Good to have you back in the studio, Adam.
Hey, Chris. Thanks for having me back again. Appreciate it.
Yeah, I'm really excited to dive in this because, I've already invested in this deal partially and looking to potentially invest some more with one of my properties. So to kind of set the stage on here, this is part of our theme for 2025, which is bringing viable deals that make sense in this new market cycle. And what's going on here is two things. We all know the market has changed. High interest rates and the old playbook used to no longer work. Hard to go out there and buy a single family or fourplex and make numbers work. And for a lot of landlords like myself out there, we're sitting on, I call a red light return on equity property. And hopefully you guys know what that is. If you don't, go to Property Llama, put your properties in there. But that's when your property is essentially underperforming the stock market, which is not exciting. So this deal, as a ground-up development for passive investing and a QOZ deal, fits into what makes sense in 2025 and beyond. So as a quick note, this is an active deal. And it is for accredited investors only. Now, I know we have a lot of people on here who have already invested or who are looking more into our Colorado Multifamily Diversified Fund, which this property, Canopy, is included along with two other properties, Weber in Springs and South Logan in Denver here. Now, that fund has no QZ tax benefits. If you want the QZ tax benefits, you invest directly into Canopy. Now, there's a few moving parts on here. If you're interested in learning more on actually investing, email us or drop a chat in the chat box on there, or email us at ir@propertyllama.com. We'll get you the details and set it up. If you're not interested in investing, that's fine too. This is also an amazing educational opportunity. I know a lot of people are newer to this stuff. Great, just sit here and learn how these deals work. Now, a disclosure, we make money by doing deals, and this is a deal that we're actively raising for. Like I said, I've already invested in myself. But the theme on here is our 2025 creating a new blueprint for what makes sense. Now, we identified 10 opportunities that make sense in the marketplace, and this actually fits 3 of them. Opportunity 6, which is trading up into commercial multifamily, potentially converting your active holdings to passive holdings, and an opportunity 9, which is investing in qualified opportunity zones on here. Now, disclaimer on here, this is a live deal, but this is actually not an offering of the deal. That will come in the PPM, which everyone go out there and view. We're also going to be doing some very high-level tax benefit analysis. I'm sharing what I've done on my own deal, but we are not CPAs. Those who go out there and consult your own CPA. And always go out there and look at your own numbers. We are sharing data that we have researched, we have sourced as well, but always go out there and do your own due diligence. So, Adam, we've talked a lot about this over last year is, everyone wants a 1031 exchange.
Yep.
They want their cake and they want to eat it too, right?
Yeah, that's right.
1031s are great because you go out there and you can a lot of times trade up from an asset that, maybe is underperforming now into a better asset for better growth, better cash flow, and we defer the taxes on here.
Yep.
I've done those. You've done those.
Yep.
We love them, right? And they're great because they defer taxes. They kick the can down the road. The problem is that 1031 exchanges right now, going from an active deal to another active deal for someone like me as a self-managing landlord, the deals don't make a lot of sense.
Yep.
The number's hard to pencil out.
Yep. That's exactly right.
I save taxes,
Right.
but I'm kind of making a lateral move in a deal making, which, great. Not a whole great reason to do it. Problem number two, and we've had many people ask this, and we explored this last year as well, is, hey, how to do a 1031 exchange into a bigger deal like a Canopy, into a Logan, or into another deal.
Yep.
On paper, it sounds great.
Yep.
Logistically,
challenging.
It's about near impossible.
Yep. Challenging for a couple of reasons, I think. One is once you come in a 1031 into another deal where there's other investors, you have to set up a TIC. Once you set up a TIC,
tenants in common.
So you have to set your partnership up that way, and then at that point in time, you're on title to the property. You're signing on loans for the property. So there's a lot of things associated with that make it, I think, more challenging. And then the second one is, there's a lot of detail behind this, but it has to be a like kind of investment. So you can't go from an operating property to a piece of land, essentially, or a development. There is an opportunity to do so, but there's a time frame, fairly long. I think it's 2 to 3 years that you have to have your money in that project before you can. I don't understand all of it behind it. Like I said, talk to your CPA, but in our conversations, it's nearly impossible to do.
And I'm using a fourplex that I actually own, and I tried to do a 1031 exchange in one of your deals or a couple of your deals last year, and really went down the rabbit hole with legal and CPA. And I was like, this doesn't work. I had $500,000 to play with. If there was a couple more zeros behind it, 5 million, 50 million,
then
different options.
Different conversation at that point in time.
I'm unfortunately not at that 8-figure investment mark yet. But this brings us to what's exciting with the qualified opportunity zone on here. And as we go through, if you guys have questions in the chat box, post them in here. We will be monitoring them live. And we're going to spend the first few minutes talking about QOZ, and then the majority actually doing underwriting on this project. So a qualified opportunity zone is like a 1031 exchange where it lets you defer capital gains, but a key difference, you only have to invest the capital gains portion, not the full proceeds. And unlike a 1031, you can sell any asset. People can sell a business, they can sell stocks, they can sell crypto, they can sell real estate, and invest those into a qualified opportunity zone property.
So essentially anything with a capital gains on it.
Yes.
That's what makes it eligible.
Yeah, which is great. So if you guys have real estate, or every year I talked to 3 or 4 people who've had successful business exits, or if you're one of those people that actually made money in crypto, hey, this might be a great thing for you. One benefit I like about this is you have the 180-day window to, from selling your property to placing the capital, which is the same as a 1031. But unlike a 1031, you don't have that 45-day ID window.
That's right.
Which makes it very difficult for identifying and DDing properties. So the big win here, and this is like the biggest difference, and I'm greatly simplifying things on here. If you hold the new investment for 10 years or longer, you'll pay 0 capital gains on the appreciated investment value. And so at the end of it, the 1031, you have to sell and 1031 again. QOZ, you invest the money into the QOZ deal, fast forward 10 years, get the money back. I get that money back in my account. It's not deferral. I get it capital gains free.
Capital gains free.
And it's liquid, and so you kind of escape that 1031 cycle without having to pay a bunch of taxes or dying.
That's correct.
So again, high level here, there's a lot of flexibility on here. There's a lot of underlying rules for QOZ, so make sure you go in there and do your own research. We're just going over the high level touch points, you can go out there and understand it. Hopefully it gets your interest, and you do a deeper dive into this deal, a deeper dive into QOZs, and of course, quite a few discussions with your CPA out there. All right, so here is the example. So here's what I call my red light fourplex. So this is a fourplex zone in Westminster. I've done some 1031 exchanges into it. I've done a cost segregation study in there, which has been great because I've deferred my capital gains for years.
Yep.
And I've actually gotten some amazing depreciation on the cost seg studies, which has brought six figures in tax savings in a single year. We can see here it's a 9.5% ROE, which is just a smidge under the 10% rule of thumb I use the stock market. I should be able to sell for about $1.15 million, have just under $600,000 loan balance, but my basis is $495. So if you do the math on there at a 22%, capital gains, depreciation or capture tax rate, I'll be about $133,000 in taxes, by about $500,000 in proceeds. Again, this is my real deal and just using it as an example, but a lot of you investors out there can relate to these numbers. So what I did here is I plugged these numbers into this calculator off of, I think, opportunityzone.com. If you want it, I'll send you, you can click this link here. It'll take you to the calculator. Not my calculator, not Narrate's calculator,
Yep.
just, a third-party calculator. And what I did here is I put in the same assumptions. Now, if a qualified opportunity zone, I will have to pay taxes on the sale of this fourplex in 2026.
Yep.
So I'll actually probably pay it in Q1 of 2027.
Yep.
When I'll have to write the check. And that's going to be, $130,000 in taxes that year. Now, there's a lot of chatter, and I've read a lot of articles on here about the new administration coming in, and they're the ones that set the QEZ in place almost 10 years ago.
That's correct.
And there's a lot of talk from lawyers and other people involved in there saying, hey, they're likely to extend it. If that happens, it would then mean I would owe my taxes in 2028 based on what they're saying right now and pay it in 2029. So that if that happens, nice big cherry on top.
Yep.
But I'm assuming, hey, I'll pay my taxes in about 2 years from recording in February right now if I were to go through on here. But what you can see on here, this calculator shows you two things. What you would owe on the property. And again, I could sell it, then hold on to money for 2 years and put into a debt fund or a stock market or T-bills and make some interest, and then make sure I have $100,000 in 2 years to pay the taxes. But here's the main point. Looking at the second half of the screen here, if I hold this property for 10 years or hold this investment for 10 years, and I'm assuming a $500,000 investment, and I'm assuming within the the range of the spectrum of outcomes on this canopy property, that I can about 3x my money over 10 years.
Yep.
And that's within the lower end, the high end range. So just simple math. So if I do that, I would put $500,000 in. In 10 years, I'd get $1.5 million back.
Yep.
$500,000 being my initial investment, $1 million being on the gain. And
Yep.
how much tax would I pay on the gains?
There
Adam?
is zero tax on that $1 million gain.
Zero tax on there, which is nutty.
Yeah.
And so
It's almost like if people are familiar with a Roth IRA, it's almost similar to that, but for real estate, and you have to, and it's a shorter time frame, right? So a Roth is post-tax dollars, but any of the gains over that time frame are tax-free that you put in there, right? And they
after 59 and a half.
Yeah, exactly, right. And they and you have to hold it for a while, and they limit how much you can put in each year too, right? So this is if people are familiar with that, that's when I kind of start thinking about this. There's to me a lot of similarities.
I like that analogy because I never thought about it, but you're absolutely right.
Yeah.
And so, based on this calculator, I'm assuming a 22% capital gains rate for, me and the Colorado state tax in 10 years. That would save me $220,000, which is phenomenal.
Yeah.
And then, hey, fast forward in 10 years, I'll have 1.5 million liquid to go reinvest. I'll have college educations to start paying for in about 12 years as well. So, kind of planning for that. So a very high level here on what this could potentially do, where yes, I'll have to pay some taxes, today or next couple of years. And this is where I'm going, hey, I pay a couple of dollars today, but I'll eventually get out of that 1031 cycle.
Yep.
And so I like it because I can, get into a great investment today, which is these bigger deals like Canopy, which is, I think, where the growth is going to be in this next market cycle versus another fourplex. And then I'll get to walk away and be liquid,
right,
and just not own capital gains the money, which would be phenomenal.
Yeah.
So a lot of information on there. I encourage everyone to go out there and research it. Adam, I know there's quite a few more details on this. We left out a few. Anything you want to touch on before we move to the underwriting?
I mean, I think you hit all the major points on the head, right? I mean, there's a lot of nuances that go into these opportunity zones with timing and when you buy the asset and all of those things. And the thing I would say is we've got a great CPA team behind us in Hanson CPA. They understand this inside and out, and we've got great attorneys that are advising us as well. One of them being one of the guys who actually helped write some of this into law.
Oh, really?
Right. So understands that side of it. So you myself, like, we are not experts in this. Like, we know enough to be dangerous, but if we're smart enough to know that when we don't know something, we surround ourselves with great team players. So,
yes, smarter people,
right? So that's the only thing I would say. I think we've hit the high level points. A lot of nuances to the opportunity zone stuff, and we've got a great team around us that are helping guide us.
Great. I agree. So we're switching with underwriting on here and a couple more details. We plan on doing a lot more education around QOZs with, doing some deal making and also hopefully getting some CPAs on here to walk us through more of the tax implications of it.
Yep.
And actually on February 20th as well, we are doing a bus tour to go visit the properties that are in the Colorado Multifamily Diversified Fund, which Canopy is part of that.
Yep.
It's also the QOZ deal.
It's also the QOZ deal.
So if you actually want to come see this as a potential QOZ deal or the fund, make sure you let us know at ir@propertyllama.com. We have about, I think, 18 seats left.
All right.
We got a 50-person charter bus. We have, I think, 18 seats left, and we held about 20 for QOZ people. So, we got overbooked there. But if you want that, great way to actually see the property and then spend half a day with Adam and some of his development team on there. Again, if you're just listening in, enjoy the education. So we're going to move over here to the underwriting Excel file for Canopy. So, 2 weeks ago, we did a great deep dive into 1000 South Logan, which is the Denver property in the Multifamily Diversified Fund. And we spent a lot of time going through a lot of the underwriting on rents and talking about the deal structure. So this time we're going to spend a little bit different part in the Excel model, right, Adam?
That's correct. Yeah. Yep. So there was a couple things we didn't get to within the model. So we said we'll hit up on those today. What I'm thinking though, Chris, let's go back to the assumptions page here. It's going to be a little to your left there. So what we'll do is we'll hit high level assumptions here. We're not going to go into depth with explaining what each assumption means. We did that in the last webinar. So I'm just going to kind of hit some high level points here, and then we'll transition over to the two parts of the pro forma that we ultimately did not hit last time.
Great.
That, with what we covered last time and then what we're going to cover today, right? We'll hit the major points of underwriting essentially a development deal. And I can tell you, the first time you do it, it's going to seem like a foreign language, and the second time you do it, it's going to seem like a foreign language. And really, the only way to really I can zip through these things pretty quick now. Every pro forma is different. We actually built this one. We took kind of a base model, and then Tanner Shulvin on our team did a great job and built the rest of this thing out. I generally know what happens in here, but when you start looking at some of the equations, it's a lot of if-then statements. But this, I think we talked last week, this model is fairly simple compared to what some models you can get are, but it's also sophisticated enough that if you're with a sophisticated investor, someone like that, it covers all the bases, right? So that's the beauty of it, is we've created this pro forma that we think it covers all of the important points that you would look for in a development. Maybe it doesn't have the sensitivity analysis that some folks might look for. That's one thing we're talking about internally right now of increasing the capacity to do that in here, but generally speaking, this is a pretty good and fairly straightforward pro forma.
Great. And I know we'll get this question. We can't show the Excel file. That is proprietary stuff to narrate, and that's typical how developers and value add guys, they have $100,000, $200,000 worth of man hours in here, if not more.
We've got a lot of man hours in this thing, probably a good 3 straight months of man hours plus, a lot of man hours. So while we're happy to share a lot of the printouts and things like that, and walk through people through the calculation. There is a lot of time that's gone into this. So and you'll see that with most investors are always a little hesitant to share.
No, most don't share, which I understand. These spreadsheets are $100,000 in cost. So happy to share the PDF for printouts or versions, but not the actual model.
Yeah, and if anyone wants to talk about how do you model this, how do you model that, I'll put you in contact with Tanner.
Volunteer Tanner. Great. So where do you want to start on the assumptions page here?
Really just I think just from we can go through the uses to you right there. That's really kind of the crux of the pro forma. And site acquisition, we've owned the site for some time now, and we've added on to the site even since then. So you got your site acquisition costs there. You've got hard costs. What I would say on this project, we're working with a group called Arco Murray as the contractor on the project. Arco Murray is a true design build firm, meaning that they are responsible for hiring the architect, all of the engineering team, all of them. And the reason we like that is we still have say in what our design is, what our unit plans are, things like that. Where we get really the benefit from a design build is, one, they have a lot of these capabilities within the firm. So they have an architect, they have
like in-house,
they have engineers in-house. So initially, when we are putting budgets together, they're getting real-time feedback. So it's not just on a whim. Excuse me, this is where we think it's going to be. So they provide a lot of value up front for that. And the main thing here was setting that budget, and then ultimately hitting that budget when we're done, right? We're ready to build it, right? Because a lot of times what you'll do is, developer math. Hey, we think it's the cost is X. No, the cost was Z actually. So it helps us manage that risk there. And this is a little bit bigger project, and Arco builds a little bit bigger project, so we thought it made sense from that standpoint. And then you might ask, well, why wouldn't you do this on every single deal? One, it's a pretty hard process. Two, you have to have big teams from a general contractor standpoint. And then three is we are paying a premium in the pre-development phase, I would say, versus a typical contractor. Like a lot of contractors, you actually don't have to, you pay them very little for their pre-con services. We're paying them a decent amount of money, but we thought it was worth it in the end to be able to make sure our costs don't increase. Because we saw costs really go through the roof in Colorado Springs a handful of years ago, and we want to make sure we have our arms completely around that.
Was that just the typical COVID supply chain, or is that specific to Springs?
It was a combination of both.
Okay.
So it was a combination of the COVID the supply chain stuff, but then also there was so much construction going on down there that they had, the market had never seen construction, up north, downtown, right? There was a lot of construction going on. So everyone, all the subs were spread very thin, right? What do you do if you're spread thin? If you're a subcontractor, you put some crazy price out there for, plumbing, for example. Right? We saw plumbing go up 100% in, 3 or 4 months. So with that's a manpower thing, right? So a subcontractor is going to look at it and say, hey, I'm going to throw a crazy number out there. And if they are willing to agree to this number, I will figure out a way, with the amount of profit, they were making well over 100% margin, no question. So it was a combination of, I think, of both things. And that's where, I failed to hit upon this earlier, but another reason that Arco is a good partner for us on this project is they can bring resources nationwide. They're a nationwide builder, so you don't want a local guy that doesn't have reach, who hires a framer from Texas, right? That's not going to go very well.
No.
But the fact that they have a reach across multiple markets throughout the U.S., they can bring resources in, and that's something that we were talking about when we were seeing the costs go up, pretty heavily.
All right, so site acquisition is about 2.98.
Yep.
Hard cost are 53 million.
53 million, and we're continuing to work on this. We're trying to continue to get this number down. That's a big portion of this the cost of the project, right? I bet if you did the math, it's about 80% of your overall costs.
Would the any of this tariff stuff throw this, or is it just all speculation with? What's going on and potential their
yeah,
negotiating
I mean,
tactics?
yeah, I think, I was happy to see, I've always thought not to go political, but for a minute, I think there's two things, tariffs, interest rates are, treasury has gone the wrong direction and not a lot of people can understand why. So I think there's a little bit of a headwind there, but then tariffs as well, right? There was a lot of talk. There was NMHC last week, which is National Multi-Housing Conference out in Vegas. And it's a lot of the large, basically if you're involved in apartments, most people go. We actually didn't go. We just thought we need to be here and dialed in on some of our projects we're working on, but talked to a lot of people who were there, and tariffs were a big conversation.
Yeah.
Right. And in construction, there is a lot of product that does come, not so much from Mexico, but a lot from Canada, right? Most of the wood that is built with in all the U.S., not all the U.S., but a lot in apartment construction come from Canada. So there was a lot of talk around that. But I think there was also a lot of talk around, hey, it's Trump's negotiation tactic. So, we saw what happened when he put that tariff on, right away. He had both Mexico and Canada to the table to talk. So it's creating a little bit of uncertainty in the marketplace right now. So we'll see how the next 30 days go. I think the benefit we have is, this project doesn't kick off until later this year, and we'll have certainty at that point in time, I think, with what the policies are going to look like. And I think that is where, uncertainty is what, really roils markets from debt to real estate to stock trading, right? Yep. It's that uncertainty. So, I think we're all hopeful that as the year goes on, there's more certainty around that.
Okay.
But, what our goal is to get that number down even further without compromising the quality of the project.
Yep.
Yep.
Great.
So, you have the next one down, TIs. He says TI/leasee allowance. So these are your TIs and lease commissions for the retail space here. So we've got retail
tenant improvement.
Yep. So this is just a capitalized number, right? This, if you recall, this has ground floor retail. So this accounts for the cost to get retail tenants within that into that space. Soft costs. This, you look at this number and you're like, okay, what does this consist of? This is what we're going to go through today. On our last dive into the pro forma, we did not get to the soft cost section. It's a very important section of your overall budget. Outside of your hard costs, it's your second biggest cost in the project. So we'll go through and soft cost term is actually thrown around quite loosely. Sometimes it includes financing, sometimes it doesn't include financing. So you just want to be very clear when you're talking soft costs. And what a lot of people do, a lot of developers do, is they just put a percentage in of the overall hard costs. They'll say, hey, it's 10% or whatever it is of hard costs. We don't do that. We build out every single cost. We've been through this, so many development projects. We know what it costs to build a project, and there are a lot of costs that people don't think about, right? Moving power lines, that'd be one of them, right? Most people are going to miss that. That could cost you $500,000 to $1 million potentially, right? Depending on project and location and jurisdiction you're dealing with. So there's just a lot of, you can't just do a blanket. You just can't do a blanket. So that's why we want to dive in deep today to just, let the audience know this is kind of what that number consists of.
Great. So $9 million soft cost.
Yep.
Just under $500,000 in financing fees.
Yep. Financing fees. That's a 1% on the total loan amount.
Okay.
So that's a pretty simple calculation. Construction and development fee. So this ties out to, see on the right side there, it's 3%. That's pretty typical. Actually, typically your development fee could be 3%. Your construction management, it could be 2%. We say, and that's paid for kind of the risk we take, the oversight of construction, all of those things, right?
Yeah.
That's your developer, quote unquote, profit on the deal. But
we got to keep the lights on too.
You got to keep the lights on. And what a lot of people don't understand is like that hard cost number up there, we're guaranteeing that hard cost to our investors. So if we mess that up, that fee
coming out of your
comes
side.
Out of our, that fee goes to help cover that, right? So it's not a guarantee, yes, it's not always a guarantee, right? And with some investors, we can cap that at our fee. There are other investors that's not capped. So not only we have a $10 million error. All right, so $2 million out of our construction and development fee, and then we've got to come up with another 8 somewhere, right? So we're taking a lot of risk when and that's why we like the design build on this one, right? Bigger project, and the beauty of the design build I didn't quite get to was they control, Arco Murray has all of the consultants under their purview. So if those consultants miss something in the drawings or draw something incorrectly, that is the contractor's responsibility, not ours.
So they eat it, not
That's
you.
the big difference between you'll hear a design build or design bid build. Typically we do design bid build, but in this one we're doing the design build. And part of the reason is the size of the project and the risk associated with it.
That makes sense.
Interest reserve, that's just a calculation. That's our capitalized interest that we pay on the loan throughout the development period. And then owner contingency. This is a number that things never go according to plan, and you've got to go into a project with an owner contingency. I think we're carrying 4% here, maybe. It's in the lower left. It's just a percentage of overall costs on the project.
Okay.
And then that's for things like unknowns, right? We start digging a hole and we find a tank, right? Now we didn't plan to do that, so now we didn't have that in our cost estimate. Okay, that's money used for that. So
you made random story. I talked to a developer, just friend of a friend thing. He does a lot of development in New York City.
Yep.
And they literally found like a vehicle one time, like an old VW bug. They were digging down. They're like, oh, okay, we got to deal with this. Like, weird stuff happens.
You never know, right? You do as much due diligence as you possibly can, but we go out, we drill, right? So we drill to understand what's in the soil. We look at historical reports, but you just never know. I mean, I think the worst thing to do is hit something historical like that. That could be real bad because it delays your project for, could be years potentially.
All right, so all this adds up. Total project $72.5 million, or about $396 a door.
Yep.
All right. So, want to move to the soft cost tab?
Yeah. Let's go to soft cost tab. So
this one right here.
That's that one right there. So, and if anyone has questions and want to dive into this further, right? We're just in the interest of time, as Chris mentioned. We didn't spend a lot of time on the assumptions that we made, right? We've made all the assumptions on the debt and all of those things. You can look at the rents, you can look at the expenses, right? That's all in here. It's in the package as well, the investment memo. So we're going to kind of dive into this here today. And when we said soft cost, right, this is really kind of built out of our soft costs, and this also is a tie out of our overall budget. So the land purchase price, like that goes in separately. But once you go in, right, our phase one here was $1,675.
That seems incredibly expensive.
We got a good guy.
Okay. I mean, I've seen that way more for smaller sites that are development.
We've got a guy who we've given them a lot of business, and they treat us very fairly. So,
great.
And then miscellaneous due diligence costs. That's just you'll have things that come up like title review with your attorney, things like that we kind of encapsulate into that. So then and then what we do in the soft costs, right? So the real soft cost section is going to be next here, and the first one is your architectural and engineering. So you've got architect of record, right? So the big project. It's an expensive project. And the bigger they are, the more you have to pay for the design services. So these are basically the folks who are responsible for producing our set of drawings that we're going to build off of. So, and what we do, it says architect of record. We kind of lump everyone under the architect, right? So we've got an architect in here. We've got a mechanical, electrical, plumbing engineer. We've also got your interior designer. You've got on this one. Our civil engineer is actually under them as well. You'll see a civil engineer down here, and that was for the survey. But this is really all of your consultants for the entire project who are responsible for getting your drawings done.
Are these pretty fixed costs typically?
Yeah, you're always going to get, it's always a game, it's a fixed cost up front, and then you negotiate ad services, right? Sometimes legit, sometimes not. But we've got some pretty good partners that we're very comfortable with now, and have been through the process with them. So we know what's there, what's included, what's not.
So all these like MEP engineering fee, structural engineering fee, AV consultant, that's all part
of that $3 million. And we tend to just lump them together because usually it's under one contract. And the reason we did it on this one is we are getting billed by the general contractor for these services, right? But it's not part of the hard cost contract. So it's separate from that, but we're getting billed by them, and we get essentially we get breakouts, but then like if we're paying like this is the codes that we use when we're paying construction draws.
Okay.
So when we get an invoice in, we're coding everything against these line items, and to go in and try to break it out, like it's not a separate invoice, right? It's all on one invoice, and you're trying to break out. It's a pain in the rear.
That makes sense.
So that's why we lump it together here. Accessibility code consultant, that one's outside of the architectural record. The reason
Is that like ADA?
That's ADA.
Okay.
That's going to be your ADA stuff. It's always changing. They're always changing the rules. We build for 0.001% of the population that does have ADA, and you can really get smoked on that. So we actually like that to be outside of the architect. Some architecture firms offer it. We like it as a third party.
You mean like as a separate from a separate consultant?
Yeah, separate consultant, right? So some architecture firms have that in house. We just feel it's better to have that third party. We want to control that consultant. And then you got material testing, site inspections. So this one is like the strength of your concrete. This is, you have to get wood frame inspections. You've got to make sure your soil is compacted to meet the requirements of the city. On a bigger project, it's $100,000. Just is what it is. It's a cost you have to have these things. You cannot get city side. This isn't a belt and suspender. This is like, you can't get sign off on city stuff without this. And also we want to make sure that basically they're making sure that the concrete is up to the strength that that's in our drawings, right?
Yeah.
To be able to support the building, right? So there's certain assumptions that are made in our drawings, and we need to make sure that what we're putting in place is equivalent or better than what we had planned for.
And do you keep these third party too from the?
Yep.
Okay.
Yeah, that's always third party. Yeah, there's companies out there. We like PSI. They're a great group. They do most of our stuff. PSI Intertech.
Okay.
You'll hear Terracon is a group that does it. There's a handful of groups out there, and this is all they do. And then other consultants, engineers. There's always things that pop up. And then reimbursable and reproduction, right? That's printing of drawings. We got to pay for the architect to drive to our office. Like, they're just things that we reimburse them for.
Yeah.
So that's just a placeholder.
Okay, so all that just under $3.3 million.
Yep. Which you might say, whoa, that's a big number, but it's real.
It's all relative, right?
It's all relative.
Yeah.
It's real.
Okay.
So so then you come down here. You have permits and fees, right? So you have to pay jurisdiction permits and fees to build your building. So power line relocation and transformers. We know we're going to have transformers here. Those run about 40 to 50,000. We don't believe that we have to relocate power lines here. They're on the right. There's a possibility we might, but we're working with the city to try to get them to pay for it. Typically that would be on developer, right? If they're on your property line or on the alley on your property line and you want to build a building, you pay Excel, or it's not Excel down here. It's I can't remember who it is down here, but I think it's like Pikes Peak something. And you pay them, right? You want to move those poles, you got to pay to have those moved. And we were talking before the call, sometimes, depending on what it's, what it's feeding, those type of things, it can be, I've had a deal where it was $1 million before. Ooh. in Cherry Creek. So, so you want to do your diligence up front, but we think we're adequately covered here. Building permits and fees. We actually lump everything into, this does include our water and sewer tap fees. There is no inclusionary housing fee down here right now, but this is really just what you pay to the city to essentially build your building and get the water taps and sewer taps and everything. So
I'm curious, like what does a water tap fee on a big building or big project like this cost? I know what it costs on like a single family home or townhome. They're still 30, 40, 50,000.
Yeah, you're probably looking at 300,000.
Okay.
If I had to guess, so they have a calculation. I mean, you can go to the city website, Denver, Colorado.
Just
Springs,
depends on how big you need it.
It depends on how big you need it, right? So it's always that cat and mouse game a little bit of like you know. I mean, it could be $100,000 jump to go from a 2-inch tap to a 3-inch tap, but you have your engineers run it, and then the city, of course, they make it seem like you need to have capacity to have every shower, every faucet, and flush every toilet all simultaneously. Like that's what they ask for. So there's actually consultants out here that push back and fight back on these things to help save you dollars, where it's like, okay, like you're being completely irrational in your logic here.
200 people aren't going to shower at the same time.
Yeah, and there's no way they're going to shower, flush their toilet, and have every faucet on their unit at the same time. But that's the baseline you have to run these.
Okay.
I mean, like, you just talk about silliness. Like that's the baseline you run off a lot of these times. So, digress a little bit, but
what's the telecom fee?
Telecom fees. Typically, you've got to. I think we can negotiate this down, but every once in a while, if you're bringing like CenturyLink, Comcast, whoever into the building, you might have to put some wiring and stuff in for them. They're outside the contract. We try to get them to pay for it. On bigger deals, we're more successful because they can get economies. On smaller deals, we pay a little more. So this is
like laying the fiber from like the main pipe.
Yeah.
Is that what that is?
Yeah. Usually they'll pay for that. It's always a negotiation who runs it through the building.
Okay.
Yeah. Yeah. And we've got usually in the hard costs, this is really kind of a, hey, like if there's anything unique that they're asking for, it helps us cover that.
Okay. So this section with the building fees and water tap fees being majority is about 1.7.
1.7. Yep.
All right, so we're getting halfway to 9 million mark.
Halfway to 9 million mark. And the other thing I would say there too, Chris, is, when you start talking fees and things, right? Like Denver is more than Colorado Springs, right? But then North Glen is more than Denver, right? So you start getting the interesting thing, just as a side note, you start getting into like suburbs of Denver, right? Their water comes from Denver. So you're not only paying the local municipality tap fee, you're also paying Denver tap fee. So sometimes you get doubled up there. So that's one thing you have to be careful on when you go into the suburban markets is, like Denver doesn't have like a parks and dedication fee, right? Colorado Springs does, right? So all of these jurisdictions, and you can go out on the web. I usually have our civil do it for us, because they know where to find all this stuff. They're much more efficient at it. But we build out an entire, I don't know if it's in here or not, but we build out entire permit fee calculation for every project we do.
A little off topic here, but generally speaking, is Colorado Springs easier to work with than Denver zoning and permits?
Night and day.
Okay.
Night and day. Yeah. Colorado Springs is very pro growth, very pro development. We're, they want to see stuff happen, where Denver, I think they've done everything they possible to make sure that no one builds.
Okay.
It's much different political environment that's a lot easier to navigate from a developer's perspective.
Comment here, telecom fees and negotiating this is a complete art. I have seen a $300,000 fee be negotiated to zero when a good case was made by the developer. Having experience here is definitely a plus.
Yep. We're pretty good at it now. Yeah. And there are, there's a consultant for everything, right? Yeah. And you can bring a consultant in. A lot of times we'll bring our AV consultant in. They're already on the project, and we'll just have them do this on our behalf as well. But we've done it as well. And
audiovisual, what does an audiovisual consultant do on a
so audiovisual, an AV consultant, audiovisual, right? They're the ones that are running all your low voltage for the entire project. So, all
the actual units.
Throughout the entire building too, right?
Okay.
So like you have a fob, fob access everything.
Yeah.
That's an AV consultant doing that
Okay.
work. TVs, speakers. Sometimes they do fire alarm as well. Depending on
way
on the
more
group.
than I was picturing in my head.
Yeah. Yep. It's security cameras as well. That's a big part of it. So that all falls under the AV, right? And then within the unit, they're running all of we're actually going away from putting in traditional TV jacks and that stuff. Just no one uses them anymore. Yeah. And going to more like, they used to be the ones that would run your coax cable throughout your entire building, right? But then they run what they're called backbones up the building. So there's fiber backbones that go up buildings now. And there's telecom rooms on every floor, and it goes floor to floor to floor. And then basically all the units are tying back into that telecom room on each floor. But you'll hear backbone used a lot, and that's your backbone for the entire project to provide that.
That makes sense.
These things are hard.
Yeah, this is fascinating to learn about. So a lot of legal costs here, title costs.
A lot of legal title.
Typical.
And I should say the orange in here doesn't mean anything. We were going through a tie-out exercise recently, and we were highlighting stuff and didn't remove the highlights. So it doesn't mean anything. But, at the end of the day, you've got legal costs for everything, right? Legal purchase and sale. You've got land closing costs. You've got loan You've got loan closing costs. So what that is, that's your title costs for your, we probably need to rename this, but that's essentially your title cost for your loan. We've got legal partnership, $100,000. Seems like a lot of money, but if you're investing, if you're in a partnership with a large institutional firm, we had a deal that was much smaller than this, and our legal bills total when we were done on both sides was $250,000.
Totally believable to me, unfortunately. But
so we do whatever we can, and then you've got construction. You have your construction agreement. You got to negotiate. We have to deal with neighbors a lot. We have to pay for the bank. We have to pay to negotiate our bank loan docs. We then have to get the honor of paying for the bank's legal team as well for that negotiation. And then you've got retail, so you have to negotiate the retail leases with an attorney. So
okay,
and then you've got accounting, tax, and audit, right? So that's one thing we do. We don't have that in house. We do everything with Hanson CPA.
Yeah.
So we outsource everything. So we charge that cost back to the project as well.
Makes sense. All right, so that's a subtotal about $360,000.
Yep.
And then moving on down here to sales and marketing.
Yep. So you've got sales and marketing. So $72,500. That's what we paid to come up with our name Canopy. And we believe in doing this early on though, and we believe that having your brand tied in with your architectural, tied in with your interior design is very, very important. So we've that includes the website as well. So we do a special website for all of our development projects with information on the project. So
that's like the lease up phase.
Yeah. I mean, even past that, right? So like any project we have that's stabilized, like you can go learn about the project. You can look at the floor plans. You can take a tour of the building. You can apply online. So it's that back end website. We have not gone down the path of having a template for it. Like we've kind of created each one for based from scratch, but we also feel that each project has a different there's basic information you want to have, but we also like to make sure that the design matches what our overall look and feel is. So that's why you see website is zero. We have a website. It's just tied into the creative agency fees up above.
That makes sense.
Renderings, photography. So you want to do renderings up front, and then you want to take photos of your project at the end of the project. Collateral, production and printing. This is brochures, folders, whatever for our leasing team. We're starting to get away from, that used to be a much larger number that we're getting away from a lot of print stuff. A lot of it's digital now.
Yeah. That's why this one matters so much more.
That's why
the
that
digital
number,
website.
Actually, some people might be like 72,500. That's a lot. It's actually a deal. Most folks for customization are going to charge you well over $100,000.
Yeah, that's a good price.
Yeah. And then let's see, public relations, community outreach, kind of a placeholder, events, placeholder. Advertising, promotional, that's when we go out to market. We've set aside $50,000 to basically market our project.
Yeah. Okay. So sales and marketing, about $160,000. And then it's got brokerage fees down here.
Yep. So brokerage fees, so you've got, broker's commission.
So this is not for when you buy it. This is for when you're leasing things up and handling the operations.
That's right. Yeah. So when someone brings you a retail tenant, right, a nice restaurant, you pay that broker and the restaurant's broker for the deal. Tenant improvements. So basically, if a restaurant tenant wants to come in, we'll give them some sort of an allowance to help offset their build out costs.
Yep.
And then tenant buyouts, payments. This is unique to this deal. There was a restaurant tenant here that had a 20-some year lease left called The Bench. We probably could have waited him out at the end of the day because I don't think they were going to make it. But when we bought the land, we wanted to make sure that we didn't have a 20-year lease in place. So we agreed to a tiered buyout with them. I think we paid them $400,000 at closing, and then we still owe them $160,000 once we go vertical here.
So this is for one of the existing structures.
There's an existing structure on there. So that was a fun negotiation.
Whew. All right, so about $1 million there.
Yep.
And then
you've got FF&E. So this is furniture, fixtures, and equipment. So we are big on art. It's a pretty, actually, for good artwork, this is a pretty low number for a project of this size, but we just feel that having artwork everywhere in the project, this will be some custom pieces, some custom pieces, some prints and things like that. That's one of the wow factors that we have the ability to create is through artwork. We work with groups that help us do this, so we'll go to an art group. I know I got to hurry up. So we'll go to an art group. That's what they specialize in, and they help us design an entire art package for an entire building. Sometimes it can be cohesive. Sometimes it can be really cool, like wonky stuff. It's we really lean into our consultant to help us come up with what we think the best program is. Model unit. This is just we'll deck out a unit. Leasing office. $25,000 worth of furniture in there. Lobby $100,000 in there. Elevator lobbies. 15,000, amenity area lounge, so we'll have an amenity space, 100,000. Fitness, we've set aside 75,000 for equipment.
That's like the gym equipment?
That's gym equipment. Yeah. Seems crazy, huh?
Yeah.
You have outdoor courtyard and pool, 100,000. So basically from model unit, from leasing office to outdoor courtyard pool, if you sum all those up, I don't even know what it is, but what we'll do, we'll go to our interior designer and say, okay, interior designer, you have $415,000 to put furniture in all of these spaces. Okay. It's your furniture. It could be your little things you put up on shelves, whatever it may be. We let them disperse that however they want. So really, maybe we could just say, hey, it could be one number, because it's like, hey, if you want to spend more in the lobby and less in the elevator lobbies, for example, right? That's usually how we treat that. But we, just to make sure we're kind of thinking about every space, we break it out here.
That makes sense.
And then building startup supplies and equipment, that's going to be all your maintenance stuff, right? That's, the shovels, the ladders, the whatever it is that your maintenance teams to run the building, right? And that's a placeholder, but that's a good placeholder. So
that's 615.
Yep. So, now you can kind of see how we get to these numbers, right?
Yeah, this is cool.
It actually adds up over time. All right. So OSIP wrap policy. This is going to be your general liability for the project. Once you get above about $20 million, do you want to go with an OSIP wrap? And the reason that you do that is that insurance policy will go with the project, right? And then you've got builder's risk, which, so your OSIP wrap policy, it's actually builder's risk, and we actually have a kind of mix these up here a little bit. So your OSIP wrap is actually your builder's risk, and then the GL policy should be is the 296. So it should actually be up one line item here. But this is the cost of insurance for a project like this. And
this is just during the construction phase.
This is just during construction, right?
This is not the ongoing property and casualty.
This is not the So that goes into your expenses, right? So we went through I think expenses last week. That's you have an insurance expense for ongoing operations. You might say this is a lot, but I can tell you we have a much smaller project, 78 units, that we just had a little issue with, and the total claim is going to be well over $1 million. So and these are indications. We work with insurance brokers to get these numbers for us. So these are real indications with where the market is right now.
Yeah. All right, so about 1.1 in insurance, which that's not surprising.
Yep. Development fee, we actually broke that one out separate, but that is probably a soft cost. Developer reimbursable, this is usually not spent. It's kind of just it's really a contingency line item.
Okay.
Like for example, we have a project where our equity partner comes into town, right? When they come into town, they send us the bill for it, right? We charge it to this line item. Real estate taxes during construction. This is just what we think we're going to pay in taxes while we're under construction. Operating deficit lease up. This is a number, right? There's a shortfall from the time that the building opens until the time is actually the project is actually covering itself from an occupancy cash flow perspective.
Yeah.
So you open, hopefully we're going to open pre-leased, but there's always going to be a shortfall where we have to pay our leasing staff, right? All of those things. These are basically your expenses that you're out of pocket until the property can cover its own expenses with the revenue it creates.
And I guess you categorize that different than working capital, huh? Because in my mind, that was always just part of working capital.
They can kind of go back. We have 25,000 in here. Excuse me. So we have 25,000 in here for this. So this is kind of a placeholder.
Okay.
In the budget. I think of it as a contingency, probably for the operating deficit. Bank fees, they charge us. That is what it is.
Yeah,
Yep.
No escaping that.
Yeah. So then you've
and
got,
then these aren't in your soft cost, the financing reserves, right?
Nope.
Okay.
They're not in our soft costs. Like they kind of fall into it in this. Basically, you could say anything that is not a hard cost is a soft cost.
If you want to get really simple.
If you want to get really simple, you'd have two categories or three categories: land, hard cost, soft cost. Right.
Yeah.
We break it out a little more, but you've just got interest reserve. So that's your capitalized interest that you're going to pay during the construction as you're drawing on your loan. Origination fees, we talked about that earlier. That's a 1% fee on the loan amount that you're paying to the bank or whoever gives you your debt. Pre-dev investor accrued interest, right? We have investors in the project who we're paying accrued interest to. So this would be money owed to them. Application underwriting, that's when a bank is looking at a deal, right? They're going to go get an appraisal, right? They might bring in a consultant, right? They don't eat that, they charge you. And then lender's inspector, so they have their own construction inspector on site that we get to pay for.
Is that for their draws?
Yeah. So what they'll do is they'll look at the draws, approve the draw, or they'll get a draw, they'll go to the property, walk the property, make sure that what is being billed is consistent with the completion, the percentage completion that you are done with the project. And then they release their report, and then they release the funds to you each, basically monthly. We get paid, we do monthly draws here, but we get to pay for that too. And then soft cost contingency. This is pretty self-explanatory.
Yep.
Just
so
covers
for that.
Yep, covers that. And then those are really your, soft costs. And you can kind of see here we do a little calculation at the bottom.
Yeah.
Soft costs excluding financing fees, debt fees, commission.
Yeah, which kind of adds up that first summary page.
That's exactly right.
Wow.
So
this is fascinating.
Yeah. And then I think one other thing to hit is the 71631 environmental abatement and remediation. We bought the site, had 2 buildings on it. We've already done the asbestos remediation, and that was the cost of it.
Oh, okay, yeah.
Yep.
So that's just clearing the land.
So you might say this seems kind of crazy. It seems high, but when you actually go through it, these are actual costs of doing the deal. And look, we have an appropriate amount of contingency in here, but it's not like we're padding this thing heavy.
Yeah.
So. And then as you go through the project, right, like some things will come in more, some will be less. So it's always it's very dynamic, is what I would say.
So one thing, sorry, I think we're good. This is great,
but that was a lot.
Yeah. So you guys have questions on the underwriting model, reach out to us. Reach out to Adam and his team. I am not an expert on underwriting development projects. I like it. I learn. And, something that we've talked about, and we always have this question come up a lot, not just with this deal, but other deals with you and pretty much any multifamily project right now, is just like the timing of the market it's scary out there right now, right?
That's right.
And so we touched on this last time, kind of talking about the 4 phases of the real estate market cycle. With Colorado Springs, you're pegging it. Is your kind of call it being in the recession phase right now?
I would definitely say we're in the recession phase right now. We're seeing negative rent growth.
Yeah.
And I should clarify, when I say recession, like really real estate related, right?
We're very specific.
Yeah, very specific, right? Like definitely the economy down there is not in a recession. I mean, they're continuing to announce new jobs down there constantly, right? Which is why we like it down there. So when we're talking recession, we're talking really real estate, real estate cycle recession.
That's well said. And this is where, this is the best times to buy, because hey, if you could go back and buy a bunch of homes in 2009, 2010, 2011, you're a genius and a lot wealthier today. But it was scary. That's when I bought my first property then, and everyone said, Chris, you're an absolute moron for doing this. I'm like, well, I understand this property sold for $240,000 3 years ago, and now I'm getting it for $66,000.
Right.
I'm scared, but also I'm excited. To me, it seems like it's on sale. And I made a lot of money off that property. And it continues to grow every year from equity I've made off of there. And so this is one of the important things to look at, just in any deal, but also where I think this project and a few other projects threading the needle of the market timing is somewhere down here, probably a recessionary phase. Fast forward 4, 5, 6, 7, 10 years. This one for a
this is
deal.
Yep.
you're going to be selling into somewhere into the seller's market
Yep.
up here.
Yep. Yeah. I think you're eight. You're probably 8, 9 probably. By the time you sell us, maybe longer. 8, 9. And look, I don't want to be selling at 11. I mean, actually, you do want to sell at 11, but no one knows when you're at 11.
If you can.
If you, I mean,
if
look,
you can
if you're,
peak that,
yeah,
great.
that's why I don't believe in. That's why I don't believe in psychics, right? They should.
My stock trading account shows that's not true either.
Exactly. So, yeah, you're delivering in that upcycle, right?
Yeah.
And I think the other thing that's very interesting now too is now is the best time you're going to get the best pricing right now as well, right? Costs have come down a little bit. We're continuing to see if we can't get more cost savings in these things. But when you're if you're one of the, it's kind of the Warren Buffett approach, right? Do the opposite of what everyone else is doing. No one's building right now. Well, we know real estate's cyclical. It's always going to come back, always has been. And when you look at the forecast here, there's nothing coming after, really what's being built right now. And anything that you see in here is all an assumption, right?
Yeah, I mean, so this is a CoStar report, and we are, so this was a Q3 CoStar report. And so we're here in Q1.
Yeah.
I mean, nothing,
right? And we know the deals are going to deliver this year. And the other thing I would say too, Chris, this is market wide. So there was a lot of development up north that was that's garden product, right? Not comparable to the stuff what we're building in the core, right?
Northern Colorado Springs.
Yeah, Northern Colorado Springs. So there's one deal under construction right now. Not there's maybe one deal coming behind it that they're talking about, but there's not much coming behind this at all. So when you look at it, right, they're expecting rent growth to really start taking off later this year. So, so if we can buy out the project from a construction perspective in a down market, you're gonna get the best pricing. You're building while everyone's kind of looking at you saying you're crazy, and then you're delivering into a market that's become hot, and then you're a genius.
Yeah. Well, that is my
I don't
plan.
know about that, but that's just it. I've been I've seen it just happen. The last cycle I was a part of as well. Yeah. And it was, we all thought the world was ending 08, 09. And sure enough, just back to your story on the deal the first deal you bought, right? If you go against the grain a little bit right now, you're probably going to get rewarded for it later on. And if you're a believer in the Colorado Springs market long term, now is the time to be designing. Later this year, early next year, you start building. And then you're deliver. It's a two year build, right? So 2 years is the market's going to be recovering for 2 years. It's going to get through all that new absorption, and then rental rates are going to continue jumping, and hopefully you outperform what you think you're going to perform at.
Yeah, and I mean, just on the note, two trends I'm looking at here again, because I've already invested. I've invested in the Colorado Multi-Diversified Fund. I invested some through my self-directed retirement account. And then in the process of getting the fourplex listed, with the fourplex, I like the market cycle where, hey, I think it's a great time. I want to get into more value add or ground up stuff right now, and then also I'm moving more money from Denver to Springs and just Denver to other states as well. Yeah. And I think if I could buy an index in Denver or an index in Colorado Springs, SP 500 in Denver, SP 500 in Colorado Springs,
I'd go Springs.
I think the Springs is going to be higher in 10 years. Is my best crystal ball.
Yeah. Look, this is one of a handful of projects we have down here. So we were very bullish on this before interest rates started going up, and so was most of the nation, right? There was a lot of institutions that wanted to be in Colorado Springs and couldn't be down there because there wasn't product available for sale. Yeah. So yes, there's a short-term blip here, but if you believe in the fundamentals and the long-term growth here, then this is a great market to be in. Right.
Well, I know a couple months passed here, so Adam, I appreciate your time.
Thank you.
I know you got more stuff to do spreadsheets all day, but this was fantastic. If you want to ask questions, let us know. This was a great look at kind of under the hood for the numbers on here.
Yep.
If anyone wants to look at more details on this as potential investment, let us know.
Yep.
Happy to send them to you. Like I said, we do have a bus tour coming up on Thursday, February 20th.
Yep.
And we are, I think, about 2/3 filled up. But if you're interested in learning more about the projects, especially the qualified opportunity zones like this, and there's a sister project that Narrate has in downtown Colorado Springs, which is also correct. A QEZ deal.
Yep.
We'll do a site visit there just to see it. And in the future, we'll be doing a webinar.
Yep.
But I'll be continuing to share kind of my numbers I get out from my accountant. And as I get into more of the details of, hey, if I sell this fourplex, here are my numbers. Here's my estimates on investing in Canopy, this other deal, and some other things I'm looking at. So we're just here to be a resource, here to give you guys ideas what makes sense to the marketplace, and hopefully here to get you into some better deals for next market cycle. So Adam, thank you so much.
Hey, thanks for having me.
All right, if you guys have any questions, let us know. Otherwise, we'll see you on the bus tour, or in 2 weeks we are doing the third deal on their multifamily development on Weber in Northern Colorado Springs.
That's correct.
Thanks everyone. We'll see you soon.
Thank you.
Bye-bye.